Hello and welcome to Laundromat Ownership. Whether you've just arrived or you've been here for 20 years, hopefully we'll have something useful for you today. I'm your host, Ian Gallahan. Me and my business partner own 3 laundromats in the Tulsa, Oklahoma area, as well as Wash, Dry, Fold POS, a laundromat point of sale company. In 2025, our 3 laundromats will do about $2.5 million in top line revenue. We'll provide 25 to 30 jobs in the local community, and we also try and provide a safe and clean space for families to do their laundry. In our laundromat point of sale company, I've interviewed around 3,000 laundromat owners in the past 10 years, and I've learned some really interesting things, some of which I'll be able to talk about on the podcast today, and some of which I vowed never to speak of again. All right, so let's get into what we're talking about today. What is your laundromat worth? What should you buy a laundromat for if you're looking to buy a new one? What should you sell your laundromat for if you're looking to exit? What metrics are the best metrics to use, and what do they mean? This is a topic that I am very excited and passionate about. At the Christmas table, me and my nephew were talking, and we just kind of ran out of stuff to talk about. He's 11. I'm trying to get him excited about investing in Pepsi or Coke, which are like 2 of the big brands that he knows about, Coca-Cola and Pepsi. And so we kind of started talking about how would you even evaluate Pepsi or Coke? Which one is the better value? Which one should you buy? And part of what we talked about was not just the stock price, that doesn't really tell you much, but the price to earnings ratio, right? That's a multiple. You know, at the time we had the conversation, you needed to own $23 worth of Coca-Cola to make $1 worth of Coca-Cola's profit, right? So it was worth 23x its earnings. And then for Pepsi, it was 27. So you need to own $27 worth of Pepsi to have $1 worth of Pepsi earnings. But we're not going to get super into stocks today. We're going to talk about laundromats. But what's interesting, and the reason I even bring up stock valuations, is because you are talking about something similar. You're talking about a multiple of earnings. What's different is the multiple amount, and then the actual earnings themselves. You're not going to be looking at net profit for a laundromat like you would for a public company. So before we get started on this, there's some of you that might be thinking, what a useless episode. Laundromats are asset sales. Don't you know it's just the assets? Asset sale is how you are buying the laundromat, not what you are buying. And that's really, if you're buying a real laundromat, that's a real business that's doing real profit and making real income, then you're going to be valuing it on the assets and the earnings. So let's cover the assets first. Most people will try and bundle these into the earnings multiple. I'm going to propose that maybe you shouldn't do that, at least not in your own head. Even if that's, what you agree on in the negotiation table is, 4x earnings, but then you've got the assets wrapped up, fine, that's just communication. But what you really should have in your own head is a really good idea of exactly what the assets are actually worth to you as a buyer. And even as a seller, you should have this as well. So why are they called asset sales then if you're buying the business and not just the assets? It's because you're buying the assets new so that you can depreciate them from the value that you paid. If you were to actually buy the business, quote unquote, you'd be buying the corporate structure behind it. So if it's an LLC filing as an S Corp, a C Corp, in those situations, if you took on that whole business, you'd have to take on their books as well. And in their books, they've likely already taken the tax break, right, of the accelerated depreciation of the equipment. In laundromats, you're typically going to do a Section 179 depreciation acceleration. So if somebody goes and buys $500,000 worth of laundry equipment, they're almost always going to Section 179, accelerate that, take the $500,000 hit on their net profit that year, because then they don't have to pay taxes on that money, which is fair because they spent that money on the laundry equipment. But you don't then want to buy it for $300,000 and not be able to depreciate it because it's already been fully depreciated. So you want to bring it into a new corporate structure and have a fresh depreciation schedule. And last but not least, their LLC, if they're anything like our 1,200 plus customers at Wash, Dry, Fold POS, it's probably called like 3 Dudes NY2 Washing LLC or some crazy acronym type of thing. And you probably don't want that to be the name of your business that you own. So it's an asset sale because you're buying all the assets, but some of those assets are going to be what we call intangible assets. They might be goodwill, which is just how you kind of account for a multiple of earnings. They might be the name. So you might have, I know when we purchased our laundromats, We have a line item on our balance sheet about the name. Now, I did go ahead and get it trademarked later, but even without the trademark, it's still worth something. We did buy the non-compete just because that was something that the lawyers wanted us to do and is kind of a typical part of one of these agreements, is that the previous owner isn't going to compete with you. So some of these assets that I'm listing here, even though they do end up on the balance sheet, they're not really something you would pay for. What you're really paying for is the equipment plus the earnings. And so what you really want then is to have a good handle on what the equipment and the land and the property, if you're buying, like, two of our laundromats have property and buildings. And so you just get those appraised and you value those, and then you just kind of have those over to the side, and then you evaluate the laundromat and base the business on a multiple of its earnings. So now that we have assets addressed and put off to the side, let's get in to what I really love to discuss, which is valuation metrics. So I made a little graph here, and I'm going to post this on washdryfullpos.com. If you look in the blog section, it'll be there. It's what's called a concentric circle graph, and you don't have to be looking at it to really understand what it is. There's a large circle, and inside that circle, fully encased in that circle, is a smaller, and then inside of it is a smaller. Think of like one of those little Russian doll, toys that you get a little smaller Russian doll each time. That's really what we're talking about today. And by the way, I looked everywhere for something like this because I did not want to build a graph, but nobody else has this actually spelt out for you like this that I could find. And then when I asked AI to do it, it just gave me like the most crazy gibberish ever, even though I prompted it several times in several ways. So I think this is something that is not widely understood. And if you understand it, you will have the advantage in the negotiation of the laundromat. In my view, this is extremely important, not only for when you're buying and selling, but for when you're owning. If you really want to understand how much equity you have in your laundromat and how big of your portfolio it is, you also need to understand this so you can give yourself a market valuation on your laundromat. There's one bigger circle, imagine, that goes around this whole concentric circle of valuation metrics, which is just operating revenue, right? You could call it gross profit. There's a few things you could call it, but it's essentially, if the laundromat is profitable, then we start at that very large gross profit number. But the reason I didn't include that is because that does get whittled away quite a bit, even before we get into this very first circle, where we're going to start with the very first valuation metric that you might use. Now, before you get to seller discretionary earnings, which is, in my view, the best metric to use when valuing a laundromat. Even if you just dissect the name SDE, Seller Discretionary Earnings, what that is describing is how much of the earnings is at the seller's discretion to spend or use. And so you can use it for many things. You could use it to free up your time. You could use it to reinvest in the business, or you could just pay yourself with it. But maybe you're not paying yourself in cash. Maybe you're just paying down your loan and decreasing your liabilities. So there's a lot you can, it's at your discretion as the seller, what you do with them. And as a buyer, those are going to be your earnings as well. So owner discretionary earnings, I've never heard that term, but it is one way to think about it, because whoever owns the laundromat, this is going to be their money to decide how to best use. When you go from, gross profit, which is just, includes a lot of your revenue, right? You do have some other costs like salaries and even some of your overhead before you get to the seller discretionary earnings. When you're at seller discretionary earnings, that really means, what is the business actually making after it's paid for all the things that aren't optional? And I'll give you a quick example. You're like, well, what would it pay for? Why would I pay for something that's optional? When we bought our laundromats, not to bust John's chops here, but you need something for the customers to read. John is a big music lover, as am I. One of the things that he would buy for his customers to read was these kind of guitar and music subscriptions, these magazine subscriptions. And that makes perfect sense because he gets to enjoy them, and so do his customers. When we bought the laundromat, we're not going to buy magazine subscriptions for our laundromats. That's just not, we don't read magazines anymore, right? So for us, we still offered the free coffee. There's a lot of things that we still offered for customers, but we got rid of the magazine subscriptions. Now, where does that money go? It goes right back into the owner's pockets. And so that's an example of something that would not really make it, it's not really truly a business operational expense. A better example is probably just a commercial vehicle. That's probably what you're going to see as something that you would pull out and say, okay, it's called a business expense right now, but really it's seller discretionary earnings because we don't need this sedan for the laundromat. A vehicle would be a perfect example, assuming it's not like a delivery vehicle. Let's talk a little bit more now about seller discretionary earnings, which remember, seller discretionary earnings is the one that I recommend using the most. It may not be what the seller wants to use, and so we will address that and talk about what the seller might use, but the seller discretionary earnings is the most important one. It's also very debatable, right? And you are going to be in a negotiation about what even SDE is, because you actually kind of want to keep it smaller as a buyer, right? And so you might say, well, yeah, of course I need this manager at this location, and that's part of the real cost of managing this business. And that's certainly what we did when we bought our laundromats, and we have no intention of replacing any of the employees. In fact, we've hired and promoted new employees. But that's a good example of, we looked at it and we were like, actually it's too large. We need to make it smaller because you're understaffed, right? So as a buyer, we looked at it and said, they don't have a facilities manager, but there's 3 locations. Things are breaking all the time. And there's a lot of things that are broken right now. And so either we're going to be putting all of our time and effort into fixing all these things, or we're going to hire someone that will fix and maintain all the facilities. Obviously, we chose the latter. But so we actually then decreased that seller discretionary earnings. We decreased the size of the circle. The buyer's going to want it to be small. The seller's going to want it to be big. SDE does not address in any way CapEx. And remember, we talked about just valuing all the assets independently of the multiples and not trying to put them in. That's what SDE does anyway. So whether or not you want to try and throw the CapEx into the multiple, if you're doing that, you're just confusing yourself and everyone, because SDE, by definition, seller discretionary earnings, does not cover CapEx. It does, however, here's the real key point, it includes the owner's salary. Now, if it's an LLC, they might not have a salary. Maybe they just take the profit from the business, they call that an owner's distribution, and that's what they pay themselves every year, and it varies wildly based on how much equipment they bought that year. That's fine. But any laundromat that is doing over $100,000 in profit, which I would say is certainly most multi-location store laundromats, you're probably going to have it file as an S Corp. LLC filing as an S Corp is the most popular, most practical. There's a lot of reasons why that's the best structure, in my view, to run a laundromat. If you have outside investors, then you might need to do a C Corp. But assuming you're not taking outside equity holders, you're most likely going to be an LLC with a tax filing status as an S Corp. Why is that relevant? The SDE includes the owner's salary. So they're saying, okay, let's say the SDE for this laundromat chain, let's call it $1 million. Well, in that $1 million is at least $100,000 worth of owner salaries if there's multiple owners. That SDE includes that owner's salary. I'm focusing on this because it's going to transition us well into this next one. SDE is most commonly used for small businesses under $5 million. So it is kind of the rule of thumb valuation metric to value a company under $5 million of revenue annually. What if it was over 5 million? And what if the seller starts talking to you about EBITDA? What is EBITDA? Earnings before interest, taxes, depreciation, and amortization. EBITDA also excludes CapEx. So remember how we were talking about just value the assets, set them on the side? EBITDA by definition does not include assets. It's an earnings multiple. So just in reality, and by the way, remember the concentric circle thing? We've gone from just operating revenue, we've shrunk that down into seller discretionary earnings, which are like actually revenue that can benefit the owner of the laundromat in one way or another. And then we've shrunk that down to EBITDA. Remember our example, we said there's $1 million worth of SDE. Well, 100,000 of that was just being paid out to the owners in salaries, right? So if you shrink it, then you arrive at that earnings before interest, taxes, depreciation, and amortization, EBITDA. That still excludes that CapEx, but now it also now does not take into account owner's salary. So in this same example, it would be a $900,000 circle instead of a million circle. Because the million circle was like, well, what we're going to do with that $100,000, we're going to pay ourselves, right? Well, if you're considering, well, okay, I'm not going to be involved in the laundromat at all, so I'm going to have to hire 2 new managers at $50,000 each. Well, then maybe now you're really looking at that EBITDA because you're not going to be involved in the management at all. I would venture that's kind of a silly way to look at it because you are going to be involved in the laundromat whether you want to be or not if you own it. And you're going to need a manager whether you want one or not if you don't want to live there and be working on it all the time. So I would say SDE is the more appropriate metric to use. However, sometimes sellers will get confused and use EBITDA, which is really more for companies over $5 million. We're going to move one more circle in, and this one is still very important for a laundromat because this is what anyone who's a financier, so whether it's an investor or just a bank or the SBA, typically the SBA, they're going to be looking at free cash flow, FCF. And just to review, we had operating revenue, we had seller discretionary earnings. That's the real true profit that you can then put in the different buckets. EBITDA now takes the owner's salary out of that bucket and it shrank. Now we're actually going to shrink it even further into free cash flow. And why would we do that? Because we want to evaluate the business for solvency moving forward. And obviously, if you're going to give someone a loan, that's what you would be most interested in is, are they going to be able to make these payments? Not whether or not it's going to be profitable to them, but would they be able to even stay afloat? Free cash flow is really a banking metric. It's not as much a valuation metric in my view, but some people use it. It includes CapEx. So remember, we took CapEx out, we set it aside. It doesn't, just by definition, it doesn't touch SDE, it doesn't touch EBITDA. Well, when you get into free cash flow, you're saying, okay, there's that big circle of operating revenue. And what you're saying with free cash flow is, I want to know what actual cash flow that is not accounted for already doing something else, how much of that is going to come out of the business? Well, your CapEx, and CapEx is capital expenditure. And so that means your assets, your equipment. Someone's got to pay for that, right? I think Warren Buffett says the Tooth Fairy doesn't pay for CapEx. And so that is typically paid for on a monthly basis because it's typically loaned out, whether it's seller financed or it's SBA financed, whether you did it through Eastern Funding or, one of your local lenders. Whoever financed it wants their money back, and you're going to have to pay them that money back on a monthly basis. And so free cash flow is then saying, okay, you paid yourself $100,000, right? That got you down to EBITDA. But remember, you still got to pay the equipment as well. So how do we get down to free cash flow? To get down to that smaller circle of free cash flow, we took out the owner's salaries, right? We did that to get down to EBITDA. And then to go from EBITDA to free cash flow, we're going to actually say, well, we have to pay for CapEx, and that's going to shrink it even further. So that's free cash flow. Now, if you owned all your assets outright, which is unusual, but I could see if you have 1 or 2 laundromats and you've had them for a while, maybe you just own all the assets outright. So I would say the primary thing is that the payments for the assets get included now when we're looking at free cash flow, and that's what shrinks the circle. Now we've got one last metric to look at, and it's actually where we started the conversation, which was when we were talking about Coca-Cola and Pepsi and their price to earnings ratios. When you've got a large public company, you're not working with all these kind of funny numbers that are like, oh, well, how much are the owners getting paid in their salaries? You're looking at is something that is very standardized, very public. It's called GAAP standards, and it's what all public companies use to calculate their earnings. If you were to say, okay, well, what are my earnings as a laundromat? It would be your net income, right? That's what these companies, these public companies are using. When they say earnings, they mean net income. So that is used for tax purposes as a laundromat owner. So you are going to pay taxes on that net income. So it is really a very official number. It is very hard you can't just manipulate it based on some calculations that you're doing. It's going to be a number based on the decisions you've made that year. And it's excluding everything we've talked about, all the things in the free cash flow, but it excludes one more thing. And when I say exclude, remember, I'm just saying that like it's to make it smaller and smaller. We're saying, okay, what's the last, how do we make it one tier smaller? Well, now we're actually going to do depreciation and amortization, and that can really distort the earnings of a laundromat that year. And I'll give you an example. So let's say we had the seller discretionary earnings, right? Remember, we put that at $1 million. And then we brought it down to 900,000 for EBITDA. And then let's say for free cash flow for all those loans and asset expenditures that you have to repay, let's say that brings it down to now 500,000. So we went from $1 million to 900,000, but now we're repaying all our loans. We could take it out of the company, or you could use it on new equipment. And if you use it on new equipment, let's say you take that whole $500,000 and you totally retool one of your stores. Now your net profit is zero. Your net income, is zero. And so your earnings, just like if a public company had public earnings of zero, or they often have public, earnings of below zero, it doesn't mean that the company's not tremendously valuable or just insanely profitable. What it means is they were able to make a large investment. That's what they decided to use the money on. And that brought their net taxable income to zero or below zero. So one last time for the example of this laundromat, say it does $2 million top line revenue. $1 million of that is seller discretionary earnings. We bring it down to EBITDA with 900,000 because we're going to pay our owners $100,000 salary. And then we have to use all this stuff to pay back. We have to use all the money to do the loans, or we're using several $100,000 to repay the loans. So that shrinks the circle one more time. And then to get down to the smallest circle of net income, I'm showing my concentric circle graph here. We are going to take that 500,000 that we had. We're going to spend it all on equipment. We're going to take a Section 179 deduction. That is going to bring us from $500,000 that we could have put in our own pocket, but because we want to invest in the company and we actually want to increase future earnings, we reinvested it in the company. We bought equipment, and then that equipment reduced the net income down to zero from 500,000. So you can see why this is a totally worthless metric to value a laundromat on, or nearly worthless. And the reason I say nearly worthless is because if it's zero, then you don't know. But if the net income is 500,000, that's the smallest circle. And there's a huge incentive for the laundromat owner to keep that circle as small as possible because they've got to pay taxes on all that. And so if the net income is 500,000 and that's the smallest circle, well, then the free cash flow is likely more. The EBITDA is likely much more than the free cash flow. And then the seller discretionary earnings. So what is that? Owning that business, what is that really? If they had a net income of 500,000, it would be a guess, right? You would need to see the numbers. But if someone said I had a net income of 500,000, I would assume their seller discretionary earnings are $1 million, and that there's another 500,000 that they're paying themselves in salaries, they're reinvesting into the company, or they're paying off loans, maybe high interest loans that maybe I wouldn't have if I bought the business. So there are advantages to understanding all of these acronyms and all of these metrics. And if you go into the negotiation of a laundromat or any other business, and you really understand what net income is, and you really know what free cash flow is, and you really understand, even if someone throws out EBITDA, which no one should be, but they will anyway, you'll at least know what that is, and how to either shrink it or expand it into seller discretionary incomes, or you could shrink it down to free cash flow, which are much more usable metrics for the valuation of a laundromat. So just to review everything that we talked about today, we really looked at what valuation metrics should be used or even could be used in the buying or selling of a laundromat. But you also, if you just have a laundromat, you've had it for 10 years, you're going to have it for another 10. How much of your portfolio is it? Is it half? Is it 30%? Is it 90%? You don't know unless you can look at your assets, right? And then calculate your SDE. Remember, that was that largest circle. Give yourself a 3x multiple. That's, standard market rate on that SDE. Then you're going to have a pretty good market valuation for what your laundromat's worth. You don't have to go and hire someone. And it's going to change every year, right? Your assets are going to go up and down in value based on what commercial real estate and depreciation on the assets and all that. So it does change over time, and you can actually put together systems to track it. I track ours every month. So it's really been fun to talk about this stuff. This is some of my favorite things to talk about because I love productive assets in general. And anytime you have a productive asset, and typically what people mean by that is a business, right? It actually has some revenue. You have to look at valuation metrics as well. You need to know which valuation metric to use or metrics to use. and you need to know what they even mean. And so if you've got this down, you're going to be one step ahead of everyone else. And so I hope this was helpful for you today. Thanks for joining me.